Get into today's market action and tomorrow's implications with our first guest, Tony Coniaris from Oakmark Funds. Tony, housing prices are higher. Consumer debt hit a fresh high, over $17 trillion last quarter, and we've got retail earnings coming this week. So is all of that perhaps pinching retailers? Is that something that people in the market should be watching? You guys don't hold a lot of retailers.
We don't, and thanks for having me. But, at Oakmark, we don't make macro forecasts, near-term macro forecasts to drive our investments. We estimate business value, which means that, we're factoring in the near-term macro as best we can, and then trying to estimate what a business will do on average over time, and then estimate its value and invest if it's cheap enough. And we really don't have a better guess over the state of the near-term economy as anybody else.
So then why is Amazon, which does more than retail, but retail is certainly a central theme with them, one of the only retail holdings that you have? In the long term, is there some weakness or problem that you see there?
I think the misperception on Amazon is that the retail business is never going to earn a fair margin. We've seen it earn a fair margin in the past. We think it's certainly capable of doing it again. It's just the facts and circumstances around the current environment today that it's not showing up. And that's because they built out their infrastructure to such a significant degree after the significant increase in demand we saw following COVID, that right now what they're doing is they're leveraging that increased infrastructure to offer, next day delivery and things like that. So we believe the retail business will be profitable, and we own it because if you look at the business today, you're essentially getting the retail business for free if you put a normal multiple on AWS. So it's cheap on a sum of the parts, great balance sheet, great management team, and that's why we own it.
Yeah, Tony, I mean, we've seen this rally in the major averages since the start of the year, but so much of it has been top heavy. It has been led by some of these mega cap stocks. Something like half of the S&P 500 is actually trading below its 200-day moving average right now. You're a long-term value investor. Do you see a lot of value in this market?
We do. I mean, the market's trading above its normal range from a PE standpoint, but there's wide bifurcation in that. And we're finding names selling at mid-single-digit multiples of cash flow today.
So what are some examples of that?
So ConocoPhillips is a great example of that. It's an exploration and production company, one of the larger ones in the world. And if you look at Conoco, what makes it really unique is that they have this broad, deep inventory and very low-cost inventory, such that if you look at the next 10 years, we believe and management believes that they can generate 133% of the current market cap in free cash flow over a 10-year period and end that 10-year period with a production base that's 50% higher than it is today. So it's sort of like the proposition of, would you be interested, Morgan, in buying into a business and getting 133% of your capital back over 10 years and the business being 50% larger in sales volumes at the end of that? That's a pretty attractive proposition, and that's the proposition of ConocoPhillips today.
Okay, you also like Capital One in an environment where a lot of financial stocks have taken a beating. What do you think, not just about Capital One, but some of the banks out there, even non-banks exactly, things like Schwab that have gotten caught up in the mess over the regionals?
Yeah, a lot of the financials are being painted with a very broad brush today. The interesting thing about Capital One is, like the other regional banks, it's selling at a significant discount to tangible book value, forward tangible book value, and a mid-single-digit multiple of earnings. However, Capital One does not have the mark-to-market complications on the balance sheet that the other regional banks have. They just don't have as big of a mark because they didn't take those sorts of risks. Furthermore, unlike the other regional banks, if you mark their loans to market, they don't get marked down, they get marked up. So the discount to tangible book would actually get better. So you don't have the capital and mark-to-market issues you have that are jeopardizing the confidence of depositors at the other banks, but you have a very similar price on Capital One, which makes it particularly interesting to us.